Hi, welcome to today's Arch Capital Update. Now today we're going to be talking about the financial year to date. We're going to go through quite a detailed slide deck and talk a little bit about market returns and sort of what to expect when you get your reviews in the next week or so. So a bit of a longer session today. We will be sending out these reports in an email as well as this report with your reviews. So, and of course, if there's any questions throughout this, a bit of economic data today, bit of numbers, but of course we love all that. So we're going to go through it with you. Now, before I get started about what's actually happened, I'm going to bring in Josh. You all know Josh. Hey, Josh.
G'day, Nigel.
How you going?
Good, thanks.
So, what should people expect when they get their reports this year?
Yeah, look, I think a lot of clients will be pleasantly surprised with their reports this year, given the sort of uncertainty in the markets over the last 12 months and definitely the last sort of 2 and 3 years. A lot of the forecasts from last year were a bit of doom and gloom this year, but look, what we can see over the last financial year is that the market's actually, really positive, and we saw some really good performance come out over the year in all different asset classes.
Yeah, great. Thanks, Josh. Yeah, I think that's right. I think a few months ago people would have been very surprised with the numbers they're going to start to see with their annual returns, and that last period, that last sort of 4 or 5 weeks really helped. Okay, so let's get into some of the data. So what we saw in the S&P ASX 200, despite interest rates going up and a lot of turmoil around the world, this chart up here is the ASX 200, and as we can see, quite a strong return from a chart point of view, and this volatility down here, which is the chart below, is relatively low as well. So that's not a bad outcome. So the ASX, or the Australian Stock Exchange, has sort of ignored the higher interest rates at this stage, you could say. And then we look at the performance of other major markets. So we've got here the USA. So again, the annual return up 19% in general. Europe 15.7%, Japan 15.1%, emerging markets 6.9%. So in all, that developed market combined sort of index is up 17.5%. So as I was just saying before, at the start of this year, that would have been a number that not many people forecast. It's a much higher number than perhaps many expected. And then what have we seen that's raised or made people nervous about this year was the increase in interest rates. So we've seen interest rates increase from zero in many parts of the world to pretty high yield. So as we can see here, the two charts here, the red is the US and the blue is the Australian. It's a 10-year government bond yield. You can see how closely they follow each other and how they've shot up. So now we're seeing those rates well and truly heading, this is the government bond yields, well and truly heading towards that 4.5%. And as we're seeing that through interest rates in mortgages and obviously term deposit rates as well, many of those mortgage rates are well above 6%, some above 7%, and term deposit rates, so many above 5% now. I know inflation has been the big thing on everyone's minds, but in fact it's actually starting to fall. So surprisingly, despite all the doom and gloom about it, we're seeing the actual inflation number starting to drop. It hit its peak around December last year, and we're starting to see those numbers drop. Now, still very high compared to where it was. The latest numbers are around the 7% mark, so still high inflation, but thankfully we're starting to see that and the forecast coming down a little bit. So that'll have a big impact on where interest rates go next, although many expecting interest rates continuing to rise. As this chart shows, this has been the increase in the Reserve Bank official cash rate. It's now 4.1% as at 6th of June, and we're starting to see that maybe they'll increase again. They have held off for now, but we might see rates continue to increase a bit as reserve banks here and around the world really try to get inflation under control. Most reserve banks still want inflation to be well down to around 2%, and we're seeing 7% as a pretty normal rate around the world now. There's also been a lot of talk about the GDP, which is a measure of Australian growth. So GDP is really the output of the economy as a whole and the quarterly growth. So we're seeing these numbers pretty low on a historic average and forecasting to be a little bit lower as well. Still positive. A negative GDP number would be indicating a recession, and you want a couple of quarters of that, 2 to 3 quarters, to indicate that there's actually a real recession. So Australia, thankfully, has been in a very strong economic position for a long time. There's lots of talk in the press around the word recession. It hasn't happened yet. Will it happen? We don't actually know, but at the moment we're hanging in there. And it's overall a pretty healthy economy. So despite some of the talk out there, we've seen markets pretty strong. We've seen, yes, interest rates have gone up, but markets have tended to deal with that. There is some pressure coming with interest rates and mortgage rates, but at the moment things aren't actually too bad. Now we're going to look at some of the numbers. So I'm going to bring in Nick. You all know Nick. Hi, Nick.
Hey, Nigel.
How you going?
Good, thanks. Thanks for having me.
Now, so some of the numbers then. So we're going to just look through the actual performance of various markets around the world. Probably just focus on sort of that 1 year number. So yeah, how did everything go over the year?
Yeah, absolutely. I think there's some very positive numbers, as Josh mentioned at the beginning of the markets over this year. So if we focus up the top here, I think Amy's going to focus on the screen a little bit. Focusing on the defensive assets, so your cash, your Australian bonds and your global bonds, the cash was actually the best performing asset of the defensive assets this year. It had 1 year performance of 2.9%. Some of these short-term cash options, that's obviously the 1 year average, but some of these short-term cash options right now are starting to pay around 4.5-5% in app call accounts and shorter-term term deposits. But yeah, so outperformed cash 2.9%, Australian bonds 1.2%, and global bonds minus 1.2%. Notably, even as bonds recover from a poor performance last year, they still have a outperformance over cash over the 10-year mark. Moving on to the equities, as you were mentioning, Nigel, relatively low volatility and flat for most of the Australian market over the year, but finished with a really healthy number of 14.8% for the 1 year mark. In the developed markets, that was the best performing asset class across all the segments, with 22.6% over the year. That's mostly made up of the tech stocks, which have had a really big rebound over the last 6 months. I think they had 36% over the last 6 months. Moving on to the so down here in the bottom two, we've got the Australian REITs and global REITs. So that's a real estate investment trust. Australia for the 1 year still at 8.1% as opposed to 0.2% for the global real estate investment trust, but they've started to come back a little bit with the rising interest rates.
Very good, thanks Nick. So there we have it. So as the reports start to come out over the next couple of weeks, expect things to look okay. Again, unfortunately we can't forecast exactly what will happen in the next period, but what has been shown again, time and time again, is despite all the forecasts, despite the doom and gloom, interest rates are going up, inflation was going up, and we've seen actually quite positive returns. So against what some of the forecasts were, it's why we have to keep that discipline, keep that structure. No one knows exactly what's going to happen in the future, but we've got really, really robust systems now, lots of data going back, 40, 50 years of different market events, so we can always share that with you. We can go into monthly data, quarterly data, annual data across all portfolios. So plenty of questions there, no doubt. Again, just a few little things here, just to explain the difference between, Nick just mentioned it, but most of the return in this last period in the US particularly is in this NASDAQ, which is the top 100 technology companies, versus the broader S&P 500. So we've seen a big increase again with those tech companies, and rest assured all the portfolios in global have got an allocation across those markets. So we're picking up those returns. We don't concentrate on it, but you're naturally picking up that return. And that one here is just about Australian shares, which we've covered off. So again, if there are lots of questions, please reach out. We've got the team here, we've got Josh, Nick and myself. So overall, if you've got any questions, please reach out, make a time. You'll be getting reports in the next few weeks. Again, thanks Nick and Josh for joining on today. I give them lots of preparation for these videos, so it's quite humorous, the pre-cut version of these. We'll film those one day and share those around. Thanks for listening in, speak to you soon.